My name is Christopher Vecchio. I am a currency analyst for dailyfx.com, and today we'll be talking about market psychology, specifically ways to measure market sentiment. Now, before we begin, as I'm sure you guys have already seen today, the risk disclaimer, we still need to go over this. Trading leveraged foreign exchange is a very risky business. While there is a great deal for potential profit, there is also substantial risk of loss. So tailor your own trading strategy accordingly to your own risk tolerance. Anything contained here within is of my own opinion, of myself and my colleagues' research. So please do your own due diligence and don't take everything I'm saying at face value because I have been wrong before. Anything you see about hypothetical performance or anything I discuss about potentially profitable trading strategies, while it may have worked out in the past, may not work out going forward. So again, the market conditions change on a minute-by-minute basis. Anything you hear, consider your own risk objectives accordingly. But we're going to talk about market sentiment here, and I do want to address a few things that are widely discussed in the markets. And it's really about how different schools of thought view the markets. And there are really two types of views in the market. There's this classical Keynesian view, if you will, that markets are inherently efficient. This is the efficient market hypothesis. This comes out of the University of Chicago. It's more well known. It's what people really look for. There are 5 main tenets of this: that markets are objective and rational, that they tend to move towards equilibrium, that there is this price, this natural price that over time markets will move towards. Third, that all decisions that market participants make are rooted in certainty and knowledge. 4, that these outside factors like earthquakes could influence the markets. And 5, that prices are inherently unpredictable. There's also this other school of thought. It's the socioeconomic theory of finance. It's been progressed by Robert Prechter, who is an Elliott wave technician. He believes the exact opposite, actually, of what the efficient market hypothesis says. He says that markets are unconscious, irrational. He says that they are dynamic. They don't always move towards equilibrium. Uncertainty leads to some knowledge. Only what happens on the inside of the markets what matters, and prices are predictable. And that's to say, 9 times out of 10, when a price hits a certain level, given what's happened in history, it's going to react a certain way. Now, in terms of this presentation, because what everyone has been taught through school or what's in common literature and through mainstream media, markets really tend to believe in, and market participants really look at this efficient market hypothesis as what's true. I don't think so. I think the socioeconomic theory is much better aligned with what's really going on. And just looking at the points, markets are unconscious and uncertain and irrational. If you've ever seen a trading floor, you see people screaming and ripping out their hair. That's not the sign of someone who's thinking clearly. What happens on the inside, what matters? Well, you look at what happened with the Japanese earthquake, for example. That move was completely unwound within a few days, in a few weeks. So while it was a move towards equilibrium, there was that sense of dynamic price fluctuation in the sense that the markets were moving so rapidly in such different directions. And again, with these waves that we see in these markets, because people are acting in a certain way, we do see that prices are predictable. Now, one such thing that this would examine would be the discussion of how data affects sentiment. And people talk about, higher interest rates beget a currency appreciation. If the Reserve Bank of Australia is going to raise their interest rate, the Australian dollar will rise in value. Similarly, if the Federal Reserve lowers interest rates, the US dollar will fall in value. Over time, this has not held. And I found through my studies that there is no long-term significant correlation between major market data and currencies. And so what I bring up here is a chart of the dollar index. Over the next 3 slides, you'll actually see the top part of the slide remain the same. It is the dollar index from 1975 to present day. In the middle here, we have non-farm payrolls, the significant reading of the US labor market. And on the bottom, we have the correlation. Now, if you see here, what is certain about this chart, if you look around 1980, on the left-hand side, we do see that the correlation is positive between non-farm payrolls and the US dollar index. That's to say, if non-farm payrolls increase, the US labor market gets stronger. People believe that the US economy will get stronger, and therefore they will put more money in the dollar. Well, you look forward to just after 1985, a little bit further down the timeline, we see that the correlation is negative. That even as the US labor market gets stronger, the US dollar gets weaker. You can go forward even further in time to something nearer to present day, let's say turn of the millennium, 2000, We see a negative correlation again. Only a few years later, we see a positive correlation, and presently we're at a slightly negative correlation. This isn't just true for the non-farm payrolls. This is also true about the key CPI reading. CPI is the Consumer Price Index. It is a reading of inflation of the US economy. Like the other chart, the top image is the dollar index. The very bottom image is the correlation, and this one, the middle, is the CPI index. What we see here, based on common macroeconomic theory, what the efficient market hypothesis would dictate, would say that higher inflation would beget higher interest rates so that inflation could be curbed. Well, that should lead to a dollar appreciation over the years. Again, we have not seen this correlation hold. In fact, looking to present day, the correlation is significantly negative at 0.57 to the downside. Going back to 2005, we saw this correlation positive. Going back further towards the turn of the millennium, roughly 2001, 2002, 2003, this was negative. So this correlation isn't holding. And even to further underscore this point, we're looking at the Fed funds rate here. That's that middle line. Correlation's on the bottom, dollar index is on the top. We do see over the years that this correlation has flipped back and forth. Macroeconomic theory states, as the efficient market hypothesis states, that this should dictate a positive correlation across the board. A higher interest rate would lead to a stronger dollar. That hasn't happened. We even see now that it's negative. So what does this mean? Well, markets are moving on how people feel. And I do actually want to bring a quote for thought. I'm going to pay some homage to the University of Chicago School of Efficient Markets. Arthur Peugeot, one of the founders, once said, "Prosperity ends in a crisis. The era of optimism dies in a crisis, but in dying it gives birth to an era of pessimism. This new era is born, not an infant, but a giant." Now, this actually applies to everyday life. When things are going really good, they actually don't seem like they can get better. And instead of looking for things that are positive in life, people psychologically start to notice the little things that are bad. And a lot of little bad things turn into one big bad thing, and all of a sudden, things aren't going so well. There's an expression, it's darkest before dawn. On the flip side, when things are looking like they can't get any worse, then you see these green shoots, as people like to call them, signs of optimism, and then they start to grow. So that's to say, when things are as bad or as good on these extremes, the psychology tends to flip. And one of the best places to look for that is popular media. And this seems like a crazy thought, but if you think about it, that's what's happening. Places to look for these popular media would be magazine covers, headlines in financial periodicals, even at news volumes. Why would we look at magazine covers that aren't dictated or that aren't necessarily there for finance, though? Well, one of these I like to look at would be Time magazine, for example. Even Business Week has a financial periodical that is released on a weekly basis, The Economist. What you see here are that these aren't magazines, these aren't periodicals out there to report on the news. They are magazines. They are businesses. They're out to make money. So they're going to talk about what is most market moving. And if it's already happened, that's when they'll report on it. When the news volume is the highest, when the most people are talking about it in the street, when you can walk to the corner bodega or to your coffee shop, someone's going to be talking about it. That's when we'll make the front page. And we see that's actually when we have signs of turning. Now, again, Time magazine, The Economist, and Business Week are the magazines I'm going to look at because not only would we have a pop culture magazine in there, we also have two financial periodicals that, again, are released on a weekly basis, so they don't always incorporate the minute-by-minute changes we see across other news platforms, which we will touch on momentarily. But going to this, I do want to point out some interesting observations. This is Business Week's article from late 1979, The Death of Equities. Well, while we did see a bit of a consolidation in the following months, equities rallied to an all-time high shortly after 2005. Right here, this is Time magazine, and Time magazine is actually very important, and I'll bring that up again in a few slides. Time magazine in 1979, the dollar to the rescue, a bit of a tongue-in-cheek here with George Washington with a black eye. It's to say that the dollar is weakening so quickly, and the dollar is done essentially. Well, we see a period of sideways consolidation for the next 2 years, and the dollar actually strengthened to its highest level ever in the mid-'80s. Looking at The Economist, this is a magazine from late 2000. We talk about Euro shambles, how the euro is in the toilet, for lack of the better term. Well, following that, there was a coordinated intervention by the G7, actually the only coordinated intervention in the 2000s before the one in March with the yen. We see that the euro-dollar rallies over the next almost 10 years and is currently trading around 136.60 right now. So from when that euro shambles cover came out, that is around 0.85 exchange rate, we have seen a rally. Now, I do want to point out with The Economist in particular, because it is geared towards financial news specifically, these reversals tend to be on a more near-term basis, which is why we see a spike in the coming weeks and months after. And I have more Economist covers to illustrate this point. Right here, the disappearing dollar. This being a dollar index chart, that would be to say when it moves to the upside, that would be dollar strength. Well, shortly thereafter, we see the dollar gain. This is a very common one. This is in 2008, Business Week again, talking about oil in the economy. And I remember this because I had a car then. I don't have a car now. When gas was so expensive, I was not driving anywhere. And we see that Business Week is discussing how expensive gas is, and within a few months, we are near $35 a barrel right at the turn of 2008, 2009. This is an interesting article, Economist magazine, because it is very recent. This is the July 15th issue. It is a picture of the euro on a cliff that is actually Italy. And it's to say that the euro dollar, again, based on this contrarian indicator, that if the financial media is getting to it, is to say that the market has already played out the move and we're going to see reversal. Well, actually, in the coming weeks, we do see that the euro gains in value. Again, we are lower now, though. So again, those rallies are a bit shorter term with The Economist, it being a financial application. But we actually saw something more recently, a very telling signal of where the dollar might be headed. And it is another Time magazine cover. It's actually the only other Time magazine cover featuring the US dollar since that publication in the late 70s. Ironically enough, it is George Washington with a black eye on his right eye, the other eye. They didn't reuse the other cover. They were a little more creative this time, I guess. But we see the Great American Downgrade. Now, everyone was expecting, and I will say I was expecting myself, for US financials to take a hit. We did see that equity markets plummet thereafter. We did see treasuries rally, though. We have seen the dollar strengthen since the US downgrade. Now, if this is anything like the last pattern, we aren't going to see dollar strength necessarily in the near term. And certainly with unprecedented monetary policy, as has been on the table with a third round of quantitative easing coming up potentially at the Fed Reserve meeting on September 21st, we could see the dollar lose value. But what this tells us, if this magazine, a pop culture magazine, is willing to dedicate an issue purely to make money on the US dollar and is talking about how poorly the dollar's performed, it could be a sign of a reversal over the long term. And it's something to keep an eye on going forward, because as we go into this shift to risk aversion over the next several months, as I believe, with the European situation looking way worse than what Lehman Brothers was in 2008, the dollar looks to strengthen over the long haul. And that's what this is pointing to. Now, in terms of financial media on a day-by-day basis, there are also signals. We do see this in the Wall Street Journal. We do see this on Bloomberg, even New York Times to an extent, because they are a major publication. What we do want to look at would be strong language, very strong rhetoric. We're talking about, for tops, surges, explodes. The euro dollar surges to its highest level ever. We actually saw this in the Australian dollar, articles about how the Australian dollar surged to its highest level ever. Well, to the day, the Australian dollar fell from about just over 110 to near parity within roughly a week and a half. On the bottom, we like to see plummets, plunges, tanks, Euro Swiss franc tanks, as I've written myself. Then we see the Swiss National Bank talk about a peg, which completely erases that, and we see that the sentiment flip. So what is this saying? Well, these reversals tend to occur in pairs when there is an outlook within the headline. I do want to point out some things over the years that contain these signs of reversals. First, this is May 24th, 2003. Dollar plunges against the euro. This is a euro-dollar chart. That would be, say, as the line moves to the upside, it's euro strength. When it moves down, it would be dollar strength. So dollar plunges against the euro. Well, in the coming days and weeks, we see that the euro-dollar exchange rate decreases. That would be dollar strength. We see dollar surges on data, outlook of rate increase. Again, as I pointed out before, interest rates have had no long-term correlation with the dollar, even though that macroeconomic theory states otherwise. So in theory, based on this headline, that would be expecting the dollar to move lower, but because it is a contrarian indicator, we like to look at it as a sign of a reversal. And again, to the week, we see that the dollar essentially loses value there forward. Looking at other pairs, this is a dollar-yen chart. So it would be dollar strength to the upside, yen to the downside. We see yen's plunge takes toll around the world. Wall Street Journal, June 16th, 1998. This actually marked a top in the dollar-yen. The yen appreciated very sharply thereafter. Similarly, as the yen surges, Tokyo remains on the sidelines. This is November 26, 2004, Wall Street Journal. We see that the dollar-yen gains thereafter. Not just across the dollar-yen, but also, or the euro, for that matter. We're looking at the British pound here. So pound strength to the upside, dollar strength to the downside. One thing I want to point out, Bank of England says the dollar looks like a good buy. They're actually advocating selling their own currency and buying the US dollar against the British pound. Well, what happens? The sterling appreciates from roughly this 175 area to over 2 within a few months. So these periodicals, these headlines, they really aren't a strong indicator of what the market's going to do over the next few weeks. If the markets, these market news organizations, if these pop culture magazines are willing to dedicate headlines and articles about something that's already happened, the trend is probably already played out. And that's something to keep an eye on. Because again, as a contrarian indicator, meaning the opposite view, if it says euro-dollar strengthens, highest level ever, we're probably talking about a dip in the near term. Now, this is not going to fill the gap for us because we can't just trade off of headlines. We need something more substantial. And because we are talking about longer-term trends here, I'm going to bring up this commitment of traders report. And it is one of my favorite tools to examine when I'm looking at longer-term trends and looking at biases for currency pairs. Now, while personally I'd like to see a stronger dollar over the near term because I would like my dollars to buy more goods and have greater purchasing power, as a trader, I can't always do that because that would be blind. And so we want to be on the right side of the trade. We don't necessarily care about which currencies strengthen as currency traders. So we look at this commitment of traders report. It is from the CFTC, the Commodity Futures Trading Commission. It is issued once a week on Fridays. It uses Tuesday's data to report on commercials and non-commercials. There is a smaller section on what would be retail traders. It's called non-reportables. But for the sake of this conversation, we're not going to talk about them because they comprise such a small market share that it's not really worth mentioning. But the two that are worth mentioning are commercials and non-commercials. What is a commercial? A commercial trader would be a hedger, someone who is using futures for the sake of insuring themselves against future price fluctuations. So for example, if you were at my options presentation I brought up before, if Ford, an American company, is selling cars in Europe, for example, they are worried about a weaker dollar that would dig into their potential profits. They would buy euro-dollar futures. This would be reflected in the commitment of traders report. This would allocate some of their risk away from their sales. On the other side, we see non-commercials are speculators. These are small hedge funds, institutions who are trading currencies to make money. Now, we're going to talk about the overall implications of how these two market groups act, because they actually act in complete opposite of one another. And by looking at how they act opposite one another, we do see that we can get a really strong signal from market direction for these medium and longer term trends. Now for our hedgers, our commercials, we notice some trends here. They are longest at the bottom of trends, and they are shortest at the top. So let's say that when markets are going very poorly, that's when they become the most bullish. And when they're going very well, that's when they're most bearish. They're longest at the bottom. So for example, let's say the euro-dollar is at its lowest level in a year. That's when commercials would be the longest. That's when they would start buying those euro-dollar futures, thereby to insulate themselves from a future price gain in the euro-dollar, an appreciation where the euro-dollar heads higher. On the other side, if the euro-dollar is at its strongest level ever, we might see them flip, and we might see them start buying selling euro-dollar futures, thereby to protect themselves from future losses in the currency. So this is a euro-dollar futures chart. Euro strength to the upside, dollar strength to the downside. The bottom chart would be the net position of commercial traders as per the COT report. Again, it is a weekly chart because it is only released once a week. If we look at early 2007, we see that the commitment of traders are most bullish at this bottom, roughly right around this 0.90 area. On the flip side, if we look forward even closer in time to middle 2010, we see them are most bullish again at another bottom. On the other side, this is our competitive traders, speculators side. They are trend following. They are terrible at identifying the bottoms and tops. So what's to say is they are most bullish at the top, which is a terrible thing to be because that means you are missing the move. That would mean they are most bearish at the bottom. So if the euro dollar hits its highest exchange rate level ever, that's when speculators would be the most bullish. And if the euro dollar hit its lowest exchange rate ever, that would be when they were the most bearish. So what we see here at the bottom, again, this is a yen chart now, yen futures. We see that they are most bearish at that bottom in middle 2007. Again, we see they are increasingly bearish in a nearer term sense, again at another bottom in early 2010. So they're actually two different signals we get one signal from these two different groups. We see that speculators are extremely long when commercials are extremely short and vice versa. So when commercials are extremely long, speculators are extremely short. We notice that there tends to be a topping in price when these speculators are extremely long and the commercials are extremely short and vice versa, of course. So what does this tell us? Well, in terms of speculation, speculators, the non-commercials, tend to be right for the meat of the move. They are correct for the rally. Commercial positioning, on the other hand, they are wrong for the meat of the move, but they are right at calling the tops and bottoms. And by combining these, we actually can get a very clear signal of when to buy and sell. Now, just to point out here, we do see again this juxtaposition, if you will. In 2007, on these yen futures, commercials at that blue line, as before, are the most bullish at that bottom. Speculators on the bottom chart, on the green line, that is when they are most bearish, and that is a bottom. Very similarly, we do see, again, to that early 2010 example on the right-hand side of the screen here, we do note that that's when commercials, again, are most bullish, and that's when speculators are most bearish at another bottoming in these futures. So one way to do this would be to combine the two groups, and we do have a way of combining these two groups into one signal. We take the net speculative positioning, this would be the non-commercials, we subtract from that the net commercial positioning, we get our composite COT index. And what this looks like would be one signal which actually shows how extreme these trends are. If we look at, again, that bottoming in 2007, middle 2007, we see that this composite COT index is its most bearish reading ever. That would be a contrarian signal. We want to buy. We do see that the yen rallies thereafter. If we want to go to 2009 a little bit further to the right, here on the left-hand side of the chart, we see that the composite COT is at its highest level. This marks a top in the yen futures. Again, if we want to go to 2010, that example, we do see that this is when the index is its most bearish in a very long time. And again, that marks a bottom. So what we're seeing here, that commercials are right at the turns, the speculators are right for the moves, commercials are terrible at calling the bulk of the move, and speculators are nearly wrong 100% of the time. Not every time, not everything's guaranteed, but history has shown that speculators are not good at identifying these tops and bottoms. And when speculators are extremely bullish or bearish, that's a good sign of a turning point and when they're actually going to move in the wrong direction. So what we did here was to get rid of this negative 300 reading, this positive 200 reading, actually index this. So when it's 100 at that very top, which we just saw in the dollar-yen futures, or the yen futures rather, we want to sell. That'd be, say, short the yen against the dollar. When it's bearish, we want to look to buy. We have seen here, again, middle 2007, that's when it's most bearish. This would be our buy signal. And if you moved off this buy signal, we do see that this gains. We go forward again to middle of 2008. We're talking about roughly September. We see another bottoming here in our composite COT. That is another bottom in these yen futures. Going further towards the turn of 2009, 2010, what we see here is a topping in our composite COT that did mark a near-term top in the yen futures. That would say we had dollar strength thereafter. But we do want to understand context. You know, if we see these signals and they are coming after extreme moves, if we see after a very strong move to the downside, we see the dollar yen hits its lowest exchange rate ever, and all of a sudden our composite COT is telling us that this could be a turning point, this is probably an indication of a longer-term trend. Now, if we see that we have an extreme reading after a shorter-term move, let's say the dollar-yen is at 85 right now instead of 75, if you will, and we're seeing that strong signal, we could see a rebound in the near term. So it's not, we want to look at in terms of context when these signals are occurring. If they're occurring after a long downtrend or a long uptrend, we're probably going to see a big reversal. If they're occurring in the middle of trends, the move might be shorter, just a few weeks as opposed to, say, a year. We do see here, again, using the same yen futures for keeping everything consistent here, this bottoming here, bottom in the chart in terms of context. Because this is after a long downtrend in the yen futures, we notice that this is the beginning of a very strong new uptrend. Very similarly, this would be a different chart. This is our euro-dollar futures. We are a little bit lower now, roughly trading around 136.60 as of market close yesterday. We are nearing another bottom in our composite COT. So what this tells us is that we have seen these gains by the euro-dollar these losses by the euro-dollar may reaching their climax. We could be seeing a turning point soon. Now, that's hard to say because fundamentals in Europe are certainly a mess, but again, what the composite COT tells us is that the dollar's strength may be at an end. And that actually fits into an interesting picture here, because with quantitative easing round 3 on the precipice of occurring, given the fact that the Federal Reserve has announced at their September 21st meeting, that would be when they'd be likely to announce it. If they do announce it there, we are coinciding with a bottoming in this composite COT. That would be a buy signal, and that would suggest the euro-dollar to move higher. So everything kind of fits together very neatly here. So overall, what we've seen here is that the market occurs at these sentiment extremes. When things are going really well, the Bank of England says, buy dollars. That looks like a strong buy. That's a sentiment extreme. And we see that the pound actually gained against the dollar. We see that the euro's in shambles, the economist talks about. The euro has strengthened essentially month by month since then. We've had some periods of the euro-dollar weakening, but since then, that was trading at 85 exchange rate in November 2000. Here we are in September 2011. We're trading at 136.60. So we have moved higher. That is a sign of a contrarian indicator. Sentiment extreme in a market. Market psychology is very interesting, and this is why I point that out. Now, again, in terms of the speculators and institutions, these commercials, we do see here that these commercial institutions, these Nissan, if you will, they are right at the turns, but the smart money, what they do is when the commercials are at their most extreme levels, you sell with the commercials. When you're in the middle of a trend, you sell with the speculators. So you get on the correct side of the market because speculators are right for the most of the move. Commercials are good at identifying the tops and bottoms. Now, the problem with retail traders often misinterpret these signals. They try to fade the trend, and while they are correct once the move actually happens, they abandon their position because they try to play these extremes. And while this COT data is not timely for, say, a day trader, because it only comes out once a week, as a longer-term trader, if you can follow the moves that the speculators are making, these net non-commercials, and you can be on the side of the commercials, these larger companies, at these market extremes, you then can take your retail strategy to another level, putting this in your toolbox, because you can follow the trend and the turns of the trend better on a week-by-week basis. And you can actually change your bias over a longer-term period. And if you can actually make a longer-term bias, for myself, I do this. I identify my longer-term trend, work from top down. You hear other analysts talk about this. Identify your bias from the top down, and then see how the smaller-term time frames fit in with that. Using this COT data as a way to identify these tops and bottoms and the trends as your top-down approach, you can get on the right side for most of the time. And while there are fluctuations within the trend, we do see that this actually has proven over the years to be a very strong indicator of when these tops and bottoms are occurring. And if you attended my options presentation before, I note that as a retail trader, there are better ways to examine these intraday, these intra-weekly moves. You can look at options data. But in terms of longer-term trends, and you want to see where your trading plan fits in, if you want to have a good idea of what the broader market's doing, look at the commercials, because these are the institutions that need to insulate themselves from these potential losses. They need to trade these futures not to make money, but to prevent losses in their bottom line. And if they're doing that, you want to be on their side when they become when they have these extreme sentiment moves, because they have historically shown to be correct, not only in the near term, say over the quarter, but over the longer term, a year, 2 years, 3 years out. So again, as I noted, and I do want to say this before, we are seeing some extreme readings on this COD index, and that's not to say go home. Dollar-yen futures are indicating that the dollar is going to strengthen against the yen's about to bottom out. Don't empty the savings account and throw it at this. That's purely hypothetical. But again, historically, it has shown so far to be accurate. Past performance, not indicative of future results, because although these are strong readings, with the way the markets are going right now, things could change tomorrow. Thank you very much for attending the presentation. I appreciate everyone coming. If you have any further questions, I will be available to talk today, tomorrow, email. Thank you very much.